Welcome back to the Rock and Turner Investment Podcast. We're excited to have you join us for another episode filled with valuable insights and expert analysis to help shape all of your investment decisions.
Before we begin, please note the following legal disclaimer. The views and opinions shared in this podcast are intended for entertainment purposes only. Any references to regions, countries, sectors, stocks, securities, or other assets are for discussion purposes and should not be considered as recommendations to buy, sell, or pursue any specific investment strategy. This content does not constitute accounting, legal, tax, or investment advice and should not be relied upon as such. The material may include forward-looking statements, forecasts, or projections, which are inherently uncertain and not guarantees of future results. There is no assurance that any predictions or projections will materialize. All data referenced in this podcast has been sourced by us and is provided without warranties of any kind. The data may contain errors and should be independently verified before use. Neither we nor the data providers accept liability for any reliance placed on the information presented. Always conduct your own research, seek professional advice, and take responsibility for your investment decisions.
Welcome back to the Rock and Turner podcast. I'm James Emanuel, and joining me today is Chris Waller from Plural Investing. He has done a great deal of research on the programmatic acquirer in the UK named Judges Scientific. So to start with, Chris, do you want to give us a quick introduction of who you are, what you do, and why you were drawn to Judges Scientific?
Thanks, James, and thank you for having me on this podcast and everyone listening today. So I run a global small cap fund based out of New York. I grew up in the UK, but I've been based in New York since 2016. And I'm looking for 7 to 8 what I call hidden gems in the small cap markets, typically in the US, Canada, or UK, and generally in the more boring sectors, consumer, industrial businesses. And these are small cap companies that are usually the leaders in a niche industry. And so what that means is for a small cap to be a leader in a niche, that niche probably is not very well covered by the sell side or even by the buy side investor base. And so there's an opportunity there if you do a lot of in-depth research to understand that industry and business significantly better than most investors. And that's really why I try and fish in those waters. And the centerpiece of my research process is really around trying to do this scuttlebutt research, speaking to around 20 people in an industry prior to investing in a company, and then trying to speak to people like that on an ongoing basis and attending industry events like trade shows. And that's really how I try and get that understanding of a company. Judges that we'll talk about today is a company very much in that vein. It's a small business that acquires even smaller businesses that are even more niche. And so it sort of fit in with my style of investing, and I was able to speak to a number of people who in the industry who recommended the company strongly, and I thought it was undervalued as well, which is what got me initially interested.
Very good. So you run quite a concentrated portfolio. I'm guessing you look for companies that you can buy and hold for the long term. What's your average holding period?
Yeah, so 7 to 8 stocks, typically for a 3 to 5 year initial time frame. The fund is about 5 years old, and there are several of the biggest positions that were held in the fund at the beginning of the fund. So it has been 5 years, and that has played out. So we do hold for the long term. But I should also have mentioned at the beginning, I run this fund, Plural Investing, but I also started a newsletter on Substack called Hidden Gems Investing, where I do publish some of the research that I do. So one of the things I do is I try and write a roughly 30-page research report on these companies after doing that. And the reason I started doing it is I found it gave sources in an industry a reason to talk to me. If I would talk to 20 sources and share this type of research with them in return, particularly in industries that don't have a lot of research because they're so niche. And eventually I realized, why not distribute this further? And anyway, that's why I started the newsletter.
And what was your background before Plural Investing? I seem to remember you worked in the banking sector. Is that right?
Yeah, so I grew up in the UK, went to university in the UK, then worked at Goldman Sachs Asset Management in London. I worked in the global equity team and then international small cap funds there. So, I've been based in small caps for a while. That began in 2013. So it's been over a decade now. After that, I moved to the US to do an MBA at Columbia Business School and launched this fund shortly after that.
Thanks, Chris. So we've kind of touched on Judges Scientific at a very high level. They're a programmatic acquirer. What does that mean? It means that acquisition is their business. So they don't have their own operating model as such. They have a portfolio of smaller companies, and they all run relatively autonomously, so there's no integration involved. And incidentally, for those not familiar with the terminology, at least the terminology that I like to use, which is borrowed from McKinsey, incidentally, I always refer to a serial acquirer as a company that buys similar companies that need to be integrated. So they're looking for synergies between those companies. And Brad Jacobs is probably the gold standard for that model. And a programmatic acquirer is a company like Constellation Software, which buys lots of autonomous companies which run entirely independently. There's no integration required. They don't look for synergies. And Judges Scientific fits into that latter bracket. Chris, do you want to just kind of explain the name Judges Scientific gives us a hint at the kind of companies that they target? Do you want to just give us a little bit more detail on that?
Yeah, so Judges is a UK listed company, just under £400 million market cap. It trades for about 20 times free cash flow on its guidance this year. I think probably 15 times its underlying sort of earnings power. As you say, they do acquisitions of small companies, typically £5 to £10 million deals of scientific instrument companies in the UK. So these are companies that are selling very typically expensive and niche instruments like vacuum chambers, ultra low temperature instruments, instruments analyzing different rocks and soils. These products typically sell for anywhere from £1,000 up to £1 million for the most expensive systems. So very high value. In many cases, these companies invented the particular instrument or niche that they're in. So UK companies, but revenues are split about one third in the US, one third in Europe, and one third rest of world, with China being a big component of that. They have a very good track record. So over the 20 years Judges have been doing this, they've generated about a 20% return on incremental capital by my estimate. And the stock has returned just over 20% as well over that period of time. So these are good businesses, very good return on capital, leaders in the industry, sort of 7 to 9% organic growth over this period of time. And Judges is quite selective. So they've done 25 deals in 20 years. Typically, they're buying at about 5 times EBIT, although there's one bigger acquisition that we'll touch on, Geotech, which was more expensive than that. So very disciplined in their acquisition multiple, very return on capital focused. Not a lot of synergies, but they don't necessarily need them at that multiple, and with that organic growth. So their growth algorithm would be sort of 13% post-tax return based on their initial acquisition price, and then 7 to 9% organic, and that's how you get to the 20%. So that's really the business model. Their model relies on a very high integrity, hands-off approach, which is why people sell to them cheaply. They have a founder, David Stickerell, who's just moved up to chairman, and we'll talk about. And they've been very, very successful, and I expect them to continue being that successful.
Good, thank you. And in terms of your research process, you touched on it earlier. You go deep. And you interview lots of people. And for this particular piece of research, I think you said that you conducted an interview with 9 former senior management executives and 7 other external sources. Are you able just to give us a little bit more color on that?
Yeah, so I think with a company like this, it's really important to understand, do they have an advantage as an acquirer? I don't think it's good enough just to be an acquirer. There needs to be some reason why you're able to get good deals, or you're able to extract some extra value in some way. And so I think speaking to people who were either the founders of businesses that sold to Judges, or they were at the C level, is important to give those insights. And so that's really why that was how I focused my research. And what was really interesting about this company is, probably more than any other I looked at, the feedback from the industry was very, very consistent in terms of why they sold their companies, which was really around Judges' hands-off approach, and about some of the future prospects of the business.
So the company was listed in 2003 at 95 pence with a £2 million market cap. And by 2023, it reached a peak of 600 million market cap, which is a 35% CAGR. Very, very impressive. Today, it's had a bit of a drawdown. In fact, it sits at half that level, 300 million market cap, which is still a 24% CAGR, which really puts it in the kind of top decile of performers, if not higher. What exactly is the model here?
I think that as you've sort of touched on there, I mean, the key part is the revenue growth. That's what they're buying, and the margin expansion is a much smaller component of that. So I looked at the 25 acquisitions they've done so far, and on average, they pay about 5 times EBIT. And that, I think, is by far the most important factor in the success of this company, and the discipline that they've had in in, very rarely going above that. And so that's why they're able to buy in that revenue at such a good return. Now, they do have a little bit of margin expansion over this 20-year period. I think revenue growth has averaged 7%, EBIT growth has averaged 9%. That margin expansion is not really because of any synergies. Some of that's just the natural growth of the business. But we could talk a little bit more about what they do once they make those acquisitions. Really, three things they do. One is focus on reporting. So some of these companies, because they're so small, 5 to 10 million, they just don't have the type of reporting you would expect. And just by implementing that, typically it makes the businesses a bit more financially focused. The second is around leadership transition, and that's a lot of why judges get a good price, is because they're providing liquidity. And then the third thing would not be synergies, but it would be, rather than pushing changes on a company, sort of pulling them or encouraging them to make really a couple changes. One around pricing. A lot of these are very high value instruments with no or low competition, and so they typically have not exercised their pricing power. And the second thing is just around R&D, ensuring that R&D is always going to projects with a commercial purpose. So that has led to a bit of margin expansion, but not really through what I would call synergies.
Okay. Now I'm just trying to think. I'm drawing some analogies to other programmatic acquirers and thinking about Constellation. Now Constellation sets itself apart from most others. And what I mean by that is that most acquirers will look for a company that has the ability to grow. So they'll buy it at a low multiple, look for growth, and the combination of the multiple uplift plus the growth gives them a good return. Constellation Software has always been very different. It doesn't necessarily look for growth. In fact, sometimes it prefers companies that don't have a growth opportunity, simply because there's far less competition when acquiring those companies in the first instance, which means they can acquire them at a lower multiple. And all they do is effectively skim off the cash that's being generated, because the company, without a growth opportunity, doesn't have the ability to reinvest. So that money is skimmed off, and instead it's applied by Constellation as a group into further acquisitions. And so the flywheel keeps spinning. Is that a similar model at Judges?
Yeah, I would say Constellation is a really interesting model that Judges follows to a large extent, but not completely. So Constellation is probably the most returns-focused company I've come across. I mean, like you say, they're not necessarily focused on growth, they're focused on returns. And in fact, I think if you look at their organic growth, it's typically around 3 to 4%. And bearing in mind they usually raise prices by more than 3 to 4% a year, it means that they're actually happy to see volume decline and to save on cost. And they're not pushing that really on companies. They're benchmarking the managers and incentivizing them and so on. So I would say Judges is similarly returns focused, but the nature of its market is a little bit different to Constellation because it's not software. These are scientific instruments which are usually in a growth industry. So the allocation of capital that generates the best return does usually lead to growth in this industry. And so that's probably where they're different. There's not so much reduction in cost because that wouldn't generate as good a return in this industry as it has done in some software businesses like Constellation.
Okay. And are you able to walk us through why a founder of a company might sell to Judges at such a low multiple, typically 4.5 times EBIT?
Yeah, so I got very, very consistent feedback on this. So founders really have two options at this, or 2 or 3 options. So they can sell to a private equity firm, which is typically going to really cut cost and make some quite big changes to that company. They can sell to a strategic acquirer. There are a lot of scientific businesses in the UK and also in the US that make acquisitions in the UK. Again, those companies are going to make some quite big changes. They're going to rebrand the business, move the manufacturing facilities and so on. But they'll typically pay more of a premium. And then you've got the third category, which is really Judges. And there are very, very few companies like Judges, which are essentially not going to make any changes. I mean, some of the founders I spoke to were literally sort of laughing or even sort of smiling at how well it's gone, because even things like an ERP system, things that they expected would be changed, even though Judges had said they would not be changed. That's remained as it has been. And so really, they all said that if you were not the owner of the company, you wouldn't even necessarily know that there's been a change in ownership. And so for some founders who are founded what in the US they call a mom and pop business, it's really important to them to maintain their business as it was. And so if that's really important to you and you're willing to take a lower sales price as a result of that, then Judges is a good option. And that's basically why they're able to buy at low multiples. They're also unique in that they have a 20-year record of doing this. So you can, as a founder, do your due diligence, speak to other people, and you can confirm that that is indeed how they conduct business. And they also just do things in a very, very high integrity way, very clean sales process. They don't try and cut prices at the end. They very much, hold to their word. So again, if that's important to you as a founder of a company to be able to trust the person you're selling this to, then Judges is a good option.
And so these are businesses where they're the founder run private companies. The founder is looking to perhaps retire.
Yes.
He has no succession plan. And so that's where Judges come in. And then how does Judges typically find these opportunities? Is it through brokers or auctions, or are they self-sourced?
So they do use brokers, but most of them are self-sourced. So Judges have, you know, according to them, they have a database of pretty much every candidate in the UK. They've spent 20 years building this out. They have a very good reputation in the industry. So they, I think, are aware of pretty much every sale that happens within their, of their scale within this industry. So it is mostly self-sourced.
Very good. Okay. I suppose in that respect, they do resemble the Constellation model, which also has its own
Yes.
database. Yeah,
Yes.
that's interesting.
Yeah.
And
it's very hard to replicate that. I mean, 20 years of building that, building your reputation, acting with integrity throughout, it's sort of easy to say because it feels like they're not doing that much, but it's very, very hard to do. You've looked at a lot of programmatic acquirers, and I think that many of them say that this is what they do, they're hands off and so on. But in practice, I think it's a much smaller number that are actually like that.
okay, so I'm just thinking about the hands-off dilemma. You've already described that Judges prides itself on no integration. So there's no kind of staff reductions, no rebranding, no shared procurement, no integration. But does that mean that opportunities for improvements are left untapped?
I think for these sorts of businesses, probably not. I think that the serial acquirer model can work in certain industries, but I don't think in this one. So I profiled a company called TerraVest, which is a serial acquirer, and they buy manufacturers of propane tanks and other storage tanks. And in that case, steel is about 30% or more of the cost of the product. And TerraVest, through its greater size, can basically cut the cost of steel significantly. And that's a kind of very clear synergy, which doesn't involve reducing staff or making changes like that. But in the case of Judges, there isn't really that procurement benefit. And so you don't really have major benefits, major synergies like that. And I think there's a lot of dyssynergies, not just in terms of the operations. So these are small entrepreneurial businesses, and you start introducing bureaucracy. I think there's a lot of drawbacks to that. And anything that involves sort of putting two teams of people together and cultures together, I think can lead to a lot of problems. But the biggest problem actually, I think, is if they started integrating, they would lose their main advantage, which is being able to buy at such a low multiple because people sell to them, for the no synergies.
Yeah, no, understood. And what about cross-selling post-acquisition? One would assume if they're selling specialist scientific instruments and machinery, that the same customers might need machinery from multiple subsidiaries within the group. How do they manage that?
Yeah, so they don't really do cross-selling right now. I mean, I would not be opposed to them doing that if this is something the businesses themselves want. So if that's being suggested by those businesses, then it's not going to lead to any dyssynergies. So you could imagine, for example, selling into the Chinese market, it may be helpful to bring multiple of these companies together to sell together to break into a market, whether it's China or the US. So that could work at some point, but I think that would have to come organically from the companies rather than Judges forcing it down on them.
Okay, no, that makes sense. And in their decentralized model, I should say, decentralization means different things to different people. What do they centralize? Is anything centralized? I mean, I'm assuming there's some kind of cash sweeping going on. And a lot of these programmatic acquirers centralize capital allocation at the very least. Is that what happens at Judges?
Well, capital allocation is centralized in the sense that, I mean, their biggest capital allocation decision is just around acquiring new companies. In terms of the decisions at the subsidiaries themselves, going back to that point on reporting, they all have to lay out financial plans for the year and then report on a monthly basis and basically provide financial reasons why they may invest in any project. And so through that process, judges can essentially guide them to ensuring that any investments are ones with financial goals in mind, because it can sometimes be tricky with scientific groups. They can be spending on science experiments that might be great from that perspective, but not necessarily financial. So just judges is quite involved in capital allocation.
Okay. I mean, in terms of their investment criteria and business quality, one would assume they look at a lot of different companies. They don't buy everything they look at. How do they view acquisitions from the perspective of working capital, capital intensity, the ability to sell the products, that type of thing?
Yeah, so these are companies that are not going to be broken businesses. So they're not buying companies that need turning around. Typically, they want a 20% EBIT margin or higher, just as an indicator of business quality and nothing needing to be turned around. They're buying businesses that are very niche, so very limited competition. In some cases, no competition at all. And so you end up with a situation where they're buying companies that are very high quality, very sticky, which I think is important for a programmatic acquirer. A little bit like Constellation, where they buy a software company, very sticky business. This is not software, but it is very niche. It's the leader in its industry. It's high value. And so it's typically quite a sticky business, and it's got significant growth potential ahead of it. And you don't have to deal with then these decisions around how do you turn around a business, because there's then a lot more risk of misexecution.
Yeah, yeah, okay. And then now some of these programmatic acquirers stick very rigidly to playbooks, and this is a theme which I think we're going to build on through our conversation. Something that's very interesting, which didn't occur to me until I really started to dive deep into programmatic acquirers, was what I now call the OPEX versus CAPEX sales dynamic. So I don't know if you've ever thought about this, but if you're selling a high-priced piece of equipment to a company, that's clearly CapEx expenditure, and typically it has to go to the board, it has to go to the highest level. It's sometimes difficult to get that over the line. Whereas if you're selling software, for instance, which is sold on a subscription basis, then that's typically OPEX, and it comes in at a lower level, albeit recurring, and it can get signed off far more easily because it's signed off by perhaps middle management. And so, different programmatic acquirers think about this in relation to the companies that they're acquiring. And I don't know, you mentioned earlier that some of the equipment being sold by Judges Scientific sells for over £1 million a piece. That's clearly a CapEx thing. But you also mentioned that they've moved more recently down a different line, and they're looking at services. And I'm wondering if this is influencing the way their decision-making process goes.
Yeah, I don't think it's influencing the decision-making process, but I do agree that these are typically CapEx decisions. So I would say this is a weakness of Judges versus Constellation for the reasons that you've just said. These are expensive pieces of equipment, up to £1 million for a system that could fill an entire sort of room within a laboratory, £1,000 in some cases. I think that the difference is not as big as it may initially seem, because a lot of the funding comes through government grants. So quite often, Judges' customers are academic institutes that receive a grant for a particular project, and it's up to the scientists then to decide how they spend it. So they're not necessarily then getting approval for each piece of equipment, albeit these are still expensive pieces of equipment. So, and we might talk a bit later about how that's impacted them, because there has been a major reduction in academic funding very recently in the US, which has impacted them. But generally, over time, usually that type of funding is not quite as price sensitive as corporate funding might be, for example.
Okay, makes sense. Thank you. Just keeping that theme, products and services. And you've described that some of the systems they sell for over £1 million. So it is expensive equipment. I don't know if you'll know the answer to this, but what's the useful life of this kind of equipment? And what does the recurring revenue look like? Is it perhaps a razor and blade model where they're selling a high priced piece of equipment, but then there are consumables that need to be consumed through the life of that piece of equipment, and they're making money on that as well?
Yeah, it's an interesting question, actually, and I don't have a mathematical answer. But what I can say from speaking with these different people in the industry is that it's not just a one-off product sale. So a lot of these pieces of equipment are part of a system. So you may end up having multiple pieces of equipment over time working together, and that is quite commonly dictated by your grant funding. So if you have a certain amount of funding that only allows you to buy a piece of equipment, you buy some of the upgrades at a later date, upgrades or additional pieces of equipment. So these customers that they work with are usually buying on a regular basis rather than on a one-off basis, even though each piece of equipment can be expensive.
Okay. And what about service and maintenance contracts? Do Judges make a large amount of revenue down that channel?
Not really. They do generate some, they do make some money from services and maintenance with geotech, but for most of their businesses, that's not a big part of their revenues.
Okay. In your analysis, you noted that the business averages, I think, 7% organic revenue growth and 9% EBIT growth post-acquisition. And I'm just wondering, with the hands-off model where there are no changes made to the business and there's no synergies sought and no integration and no cross-selling, how exactly do they achieve this?
Yeah, so the underlying industry is growing, not just in the niches that Judges is in, but also just you could look at metrology in general. So anything to do with measurement, whether that's for industry, semiconductors, which is not really an industry that Judges is in, but you can see measurement in that particular industry as well. These are all kind of growth industries, and so that's why they're able to achieve 7% revenue growth. Judges is in the particularly high value part of the various industries, and then it has pricing power. So it's not sort of 7% volume growth. There is a significant component of that, which is just through pricing. I mean, what they find is that these mom and pop companies typically do not exercise their full pricing power, and that's something Judges very much encourages. And so you could definitely get 3 to 5% price increases over time. In fact, I've spoken to some founders who talked about how the prices of their products have even doubled in the 5 years since acquisition. Now, that's not for every company, but there are industries where the company Judges owns is the only provider of a piece of equipment, and the customer is getting grant funding and not that sensitive if they have the grant funding. You know, they'll basically spend the entire grant. So yes, a good chunk of that growth comes from pricing.
Okay, that's useful. Okay, let's move on now and talk about the playbook and the geotech situation. So, just to give some background to listeners, this is what I like to call the elephant trap. And it kind of refers to the law of large numbers. So, if you start off as an acquirer, it's relatively easy to find small companies to acquire. And those small companies, by acquiring them, it moves the needle of your performance. But as you get bigger, acquiring small companies tends not to move the needle very much. And so you find yourself in something of a dilemma. Now, we all know that Berkshire Hathaway is a programmatic acquirer. And it's currently sitting on a mountain of, I think, $380 billion worth of cash. And the reason being is it's looking for an elephant-sized acquisition that can move the needle. And there aren't that many businesses to acquire that can move the needle of Berkshire. So it's sitting on all this cash, which clearly acts as a drag on its performance. Now, we've mentioned Constellation a few times on this conversation. Mark Leonard took a very different approach to Warren Buffett. So he solved this problem. Constellation, incidentally, I think has a market cap now of about 80 billion, so sizable company. He created platforms. And effectively, he kept subdividing his company into platforms, and each platform had delegated authority to make its own acquisitions. Now, you may find this hard to believe, but all of these platforms are making acquisitions to the extent that as a group, they're acquiring two companies every 3 days. That's, more than a company every day and a half, which is mind-boggling. But they achieve it through this kind of disaggregation of the business. So they grow big by staying small. I think that's the way that Mark Leonard always describes it. Now, although Judges isn't quite on the same scale as Berkshire Hathaway or Constellation Software, it's grown significantly over the 20 years of its existence. And it also, I think, found itself in a situation where these tiny deals weren't necessarily moving the needle very much. And so it kind of broke from its playbook, and it invested in a company called Geotech. Now, Geotech has quite lumpy revenue, which is less predictable because I think it's got very high customer concentration. Chris, you'll correct me in a second if I'm wrong here. They also paid £80 million for this single acquisition, which was larger than all acquisitions combined made over the past 20 years. And the other departure from the playbook was that this was primarily a service company. It wasn't a product instrument business, the type that we've been discussing. So, arguably it was outside of what Buffett would describe as a circle of competence. And then finally, Judges paid 7 times EBIT for this acquisition versus its historical average of 4.8, I think it is. And so my question to you, Chris, is why would they bet the farm on a single acquisition? Was it desperation to deploy capital? How do you see it?
Yeah, so this is probably one of the key things that investors have focused on. So um, I think that just first of all, I think a lot of investors feel that this acquisition has not worked out. And I think it is too early to really say that. So the reason investors would say that is that a significant amount, I think about a third of the revenues of geotech comes from something called a coring expedition, which is a ship that goes typically to Japan or Southeast Asia and conducts experiments essentially looking for oil and gas in the ocean floor or other types of mapping of the ocean floor. And so usually there's one expedition per year, but if you don't have that, then that entire revenue loss drops through to the bottom line. And that's been one of the main headwinds that Judges has faced. I would say I think it is too early to say because they missed 1 year of expeditions that this whole thing has been a failure. Because actually, if you look at Geotech's history, there were years when they did not have an expedition, and there were other years when they had two, and it sort of averaged out at one per year. So, and they did have one in this year, so it's sort of back to normal now. So, I don't necessarily think that acquisition has gone wrong, but without a doubt, it is, as you said, bigger than all their previous acquisitions combined. I was surprised that they did something that big. The actual business quality is very much in keeping with what Judges looks for. So it's the only company in the world that can provide some of the equipment that it provides. So very much within that niche. And I think some of this is related to what you talked about is, when they were really small, they could just do 5 to 10 million pound acquisitions, and that was it. I would say, though, that they still are quite small, 150 million pounds of revenues. I estimate they will generate, their current guidance is for free cash flow of just under 20 million this year. I think that earnings power is probably 25. So what that means is over the next 3 years, they probably have to deploy 75 million in acquisitions. So, 5 to 10 million pound acquisitions can still make up quite a large chunk of that. If you're doing, 1 to 2 deals per year for 3 years. So they don't actually have to do an acquisition of this size. I think they were just opportunistic, and I would be surprised if they did an acquisition of this scale, on a regular basis. So, for example, since Geotech, they've made 5 acquisitions, all of them within their traditional size. So, yeah, so it was unusual, but I don't expect too much of it.
Okay. I noted earlier that they're kind of broken from their playbook in a number of different ways. But I also note, having looked at Judge's history, that they made no acquisitions at all from July 2017 to December 2019. And neither did they make any acquisitions from October 2020 to May 22. That was, clearly the COVID period anyway. But historically, it seems that they didn't try to force acquisitions. And yet, the Geotech deal kind of gives us a slightly different impression that perhaps they were looking for a big deal and they had capital to deploy. They broke from the playbook for that reason, almost out of desperation. Now, what I'm wondering, and I know we're going to come back to this later, so I don't suppose we want to go into too much detail on it here, but is this symptomatic of recent management changes and hires? There are some new guys on the board. Some of the old rank and file are soon to be kind of stepping down. Did you think this is symptomatic of those changes?
I don't think so. And I know that from the timing, it looks like they were maybe desperate to make an acquisition. But I think what makes the founder, David Cicurel, very unique is just how disciplined he is on acquisition multiple. Now, this one was higher at seven times EBIT, but it was also an 80 million pound acquisition. And as you scale up in size, those multiples inevitably go up, which is why I think they will prefer to stay at the smaller end of the scale. Like you say, there've been two-year periods where they didn't make a single acquisition, and there was another almost 2-year period. So it must have been incredibly hard as a programmatic acquirer, to do that. And he must have faced a lot of investor pressure to make an acquisition. So the fact that he didn't on those 2 or 3 periods suggests to me that he's very disciplined. And actually, the multiples that they pay haven't changed in 20 years, even though asset prices and asset multiples have gone up. The multiples they pay don't change. So I would give them the benefit of the doubt. I think they've got a lot of evidence over 20 years that they're extremely disciplined on acquisition multiple. In terms of some of the recent changes, David Cicurel has moved from CEO to chairman. He is 76. That, in my view, is really the main risk factor here, because he brings that discipline, and it's very hard to replace that. I don't think that Geotech or any other acquisition reflects the new management. I think that they're very much driven by David Cicurel. He did bring in an M&A specialist, a guy called Rick Armitage, about 6 months ago to support him in that work. So I think Rick will have an impact there to expand the number of acquisitions they can do. But I don't think in terms of some of the other C-suites that have come in to help over the last couple of years, I do not think that they will have pushed for an acquisition. In terms of the runway they have, I think that's a very important question. What runway do they have? Can they continue making these types of acquisitions? All these private companies are listed on Companies House, and that data is aggregated and can be analyzed in different ways. And depending on what way you cut the data, it looks like there are about 1,000 companies in the UK that would qualify as in the scientific instruments business and with revenues of the size that Judges would acquire. So now Judges say there's 2,000, again, depending on how you cut the data, there's different numbers, but it would suggest that there are a large number of potential acquisitions of this size still remaining.
Yeah. Okay. All right. Well, let's kind of zoom in on the management transition now. You've already mentioned that David Cicurel is 76. He was the founder. Until the last couple of weeks, he's been the CEO, but we've had this announcement that he's standing down as CEO and moving into the chairman seat. So succession is always a risk for any company. And let's think about the leadership pipeline a little bit. David Cicurel's charisma and charm are half, I think, of what sort of made the company so successful. He's been able to make these acquisitions and win over the founders of companies that are being sold. And I'm just wondering, in terms of the company's reputation, how you think it will survive his departure as CEO. Is there a real key man risk here? And kind of before I kind of hand that question over to you, I noticed that Mark Lavelle, who's the COO, he joined in 2017. He was ex-Halma, and now, for those who don't know, Halma is a similar company on a bigger scale. But they operate as a programmatic acquirer, a UK company as well, and in the kind of scientific instrument space. And he has been instrumental in managing subsidiaries at Judges post-acquisition, and he has significant skin in the game. And for a while, I think people assumed that he would be David Cicurel's successor. But he has decided to step down and retire himself in 2026. So that leaves Prestige and Wilcock. These are two characters who have very strong backgrounds. They've worked at Halma, they've worked at Oxford Instruments, again, another similar company. Danaher, everybody will be familiar with Danaher. I think both of them have kind of PhDs, so in the scientific circles, they're highly regarded. But they're relatively new to the business. I think one joined in 23, one joined in 24, so they don't necessarily have that. They're not having immersed in the culture. How much do you think will change now after Mark Lavelle stands down and David Cicurel becomes chairman, when Prestige and Wilcock step up? How much change do you think there will be?
Yeah, so I think the change will not be from this move of Cicurel moving from CEO to chairman, because his actual responsibilities, I think, will be largely the same. I think the change will be if he exits the business completely. And, that will obviously happen at some point. He's 76. I think the fact that he's staying on as chairman is quite a good signal, actually, that, he could have just retired completely, and he did not do that. And his actual role will stay pretty much the same. So I think that was reasonably reassuring. And of course, he's still got the majority of his net worth in the stock. So just to provide some background on how the management team actually works. So David really is focused on the acquisition side of things. He's not so focused on running these companies after they've been acquired. Those companies all report to Mark Lavelle, who, as you said, is and has been the COO for a long time. And then two other directors who've come in since 2023. One was Tim Prestige, and the other's Ian Wilcock. So those three really are or I should say, all of those subsidiary businesses report to one of the three. So that's how the ongoing operations are run, and I don't anticipate really major changes there because Prestige and Wilcox have been there for a couple of years. They've already been running many of those businesses, and Judges are quite hands-off anyway. So I don't anticipate too much of a change there. In terms of David Cicurel moving to chairman, although his title changes, he will still be focused on acquisitions. And I think that's really the key. That's the value that he brings. ensuring that they don't pay more than 5 times for small acquisitions, and he can do that whether he's chairman or CEO. So I think that's really the key, and that's where the risk is if he goes entirely. They did bring in this guy I think I touched on earlier, Rick Armitage, who is an M&A specialist. The fact that he's an M&A specialist does not guarantee he'll be as successful as Ciccarel. So I think that should be a smooth transition and some way down the line, but there's no doubt that's the main risk in my mind. There was also an interesting announcement they made with this press release about Ciccarel moving to chairman. So they actually announced that a guy called John Dunn was joining, or has joined, in fact, Judges from Halma as well. He's going to be titled Portfolio Chief Executive. He ran a segment at Halma of, I think, 7 businesses. So this is the first portfolio chief executive title that Judges has given. And going back to your point on Constellation, where they created these platforms and delegated the M&A to the platforms to ensure that they could still make small acquisitions, I'll be very interested to see if that is then the first move. This is the first move of Judges building these platforms out. Because that would be a new development and it would ensure they could continue making these acquisitions. And he has previously worked with Tim Prestige, who will be stepping up from business development director to CEO. I mean, Prestige has actually been the highest paid employee at Judges since joining, so even higher than Ciccarel. So this was very much planned from that moment. So it's as smooth a transition as we can get for now, until Ciccarel does retire at some point, in the future.
So this is all interesting, kind of throws up a whole plethora of kind of questions. So there seems to be a number of people from Halma who move over. Halma's obviously the bigger company, but they move over to Judges. I'm just kind of curious about why that's the case. Do they find that perhaps their progression is capped at Halma because upper middle management and moving to Judges is the only way to get to top tier management, or is there something else? And the other tension, I suppose, is that when you promote someone who has never served as a CEO to kind of the CEO role, they don't always take to it. In terms of capital allocation, corporate finance, that's not necessarily their strength. And Prestige and Wilcox are both quite academic, I think. As I said, they both come from a PhD scientific background. I'm wondering if there's any tension between kind of technical academic brilliance and commercial acumen that you ought to be concerned about.
Yeah, so I think a number of people have come from Halma. Actually, Mark Lavelle, the COO, who will retire next year, was also at Halma, and so I think he has been important. And like I say, Tim Prestige is bringing this person, John Dunn. In fact, if you go on John Dunn's LinkedIn, you will see that Tim Prestige has commented on his LinkedIn and said, nice to work with you again. So, I think that I don't know the explicit reason why so many people are moving from Halma, but I think obviously Judges is a smaller version where they can still deliver those types of returns that Halma can't do anymore. Up until the last couple of years or so, Judges share price was appreciating, very rapidly every year. So, the financial reward is much greater as well. So I think that would, and they know some of the people there. So those would be the reasons. In terms of, yes, you're right. In terms of Prestige moving to the CEO role, you never know until someone moves into that job how they will behave. It has been planned for a while, so you would like to think that he's better prepared for it because it's been 2 years. And of course, the former CEO, Ciccarel, is still going to be around in the chairman role. So, but interestingly, Prestige and Wilcox, who, like you say, both came from very much scientific backgrounds, PhDs, working with Nobel Prize winners. They have that very strong technical expertise, which helps actually with talking to these founders of companies. But they both ran divisions at Halma and Oxford Instruments, respectively, that had the same revenues as Judges. So they've actually run businesses of this scale before. Now, that's not a guarantee, but it's a good indicator, I think, that they'll be able to cope with this size.
Yeah. I don't doubt that the size is an issue. It's more a question of, running a division is different from capital allocating at the top. But again, we don't know. It's a question of, rolling the dice and seeing what happens. What's really interesting, I found, is that neither Prestige. Yeah. Sorry, go ahead, Chris.
Sorry, I was just going to make one other comment on that point you made. I did do a number of reference checks on both Prestige and Wilcox, and reference checks are not perfect. You have to take them with a pinch of salt. I think that on Prestige in particular, the feedback was he did start off with a highly technical background, and he had to learn the business side over a period of time.
Yeah.
Now, the feedback was that he was successful in learning that, and ran those visions well, and that's why he was promoted and so on. Again, it's a reference check or several reference checks, so you can't guarantee that that is completely accurate. But for what it's worth, that's what I found.
Yeah, no, that's good to know. So I was just about to say, from the research that I did, I noticed that neither Prestige nor Wilcox have made any kind of personal investment in Judges since moving over, and they seem to be relying on options and stock-based comp as a way of gaining exposure to the business. I always see this as kind of a poor attempt at alignment because it's more of a heads I win, tails I don't lose kind of setup for the management. And the other thing is the options that they were granted when they joined are now kind of deep underwater because, as I say, there's been a drawdown. It's been a multiple contraction situation where the share price is about half of what it used to be. And I'm wondering how that share price collapse might affect their morale and their incentives.
Yeah, I think obviously David Cicurel as the founder has a significant stake. I think about 45 million pounds, about 170 times his base salary. So that he's obviously 50 times his base salary in stock. All of it actually acquired, I believe, through these options. So he didn't actually buy shares with his own cash. I would certainly prefer that all the management team buy more shares with their own cash. No doubt about that. And I think it's important that Prestige is incentivized by the share price. Now, they've taken the approach of kind of awarding him these options. Like I say, I would agree with you. I would prefer that he bought with his own cash. Unfortunately, yeah, as probably a lot of people know, that's just not as much of the culture in the UK for many companies, but I would certainly prefer that. My suspicion, just a guess, is that they will award Lavelle with, sorry, not Lavelle, Prestige, the new CEO, with options in future to ensure that he's incentivized that way.
Yeah.
So that's how I think they'll correct it.
That's fair enough. And just before we kind of move on from that point, there's something that just crossed my mind as we are speaking. So you mentioned that Cicurel has a huge equity stake in the business. And it would seem that, as we said, Prestige and Wilcox haven't made any personal investments, which may be a reflection of their financial positions. That they might not be in a position, might have young families. I simply don't know. That being the case, one wonders with Cicurel being 76, how eventually he cashes in his chips. And with most of the senior management now having come from Halma, and Halma being kind of the big relative in a similar kind of market, whether you think there's scope for Halma to come in and just buy Judges out.
I think Halma would probably like that because it would be a sizable acquisition and they could use their playbook. I would be surprised from Judge's perspective if they did that because, that would probably mean Halma coming in, trying to extract synergies and basically Judges having to break its word on all of its acquisitions. So I think they would be quite skeptical of that approach. I suspect Cicurel, from when I speak to him, he doesn't seem like a guy who's about to retire anytime soon. I suspect he will just own the shares for a very long period, and maybe reduce his shareholding over time. There has been one occasion when he did reduce his shareholding a few years ago significantly. So I would expect, over the next decade, there will be other occasions like that, and that's probably how he will liquidate. I also think for people like Prestige and Wilcox who have come from bigger groups like that, to sell to a group like that would sort of counteract the reason that they moved in the first place. So I suspect that they will just keep compounding at these types of returns for a long time.
Yeah, possibly. I mean, I was just thinking in terms of, if you're the CEO and sometimes if you can orchestrate some kind of a buyout, then there's normally a windfall in it for you anyway. So there might be an incentive for them. And, just thinking that they've got those connections at Halma. But the other alternative, I suppose, is that if they are cash generative and they perhaps struggle at some point in the future to find new acquisitions, and maybe there's an option for them to repurchase stock and repurchase directly from Cicurel in order to buy out his stake gradually over time, and in that way return capital to shareholders by reducing the share count. Do you think that's the possibility? Have there been any hints that kind of thing may happen?
I think it's unlikely, to be honest, just because they have not done a share buyback and they've paid dividends instead. And as much as I would like them to make acquisitions or do a share buyback at these prices, it's just not something that they've talked about. So I think that probably won't be a route that they go down.
Okay, let's stay on that kind of theme. Just looking at capital allocation generally. So I noticed the judges increased its banking facility to 140 million. And I'm just wondering, following the geotech situation that we discussed earlier, should investors worry about the company's capacity now to do another big, bet the farm on a big deal? I know we touched on earlier the fact that they've subsequently made 5 smaller deals and perhaps have learned their lessons. But having increased the banking facility, I'm just wondering what the thinking might be.
Yeah, I wouldn't necessarily interpret that as meaning they're about to do a big acquisition that requires the facility. I mean, it's sort of hard to tell in advance. I think that this company is quite underlevered, about 50 million of net debt. So net debt to EBITDA about 1 time. So they have a lot of capacity. They're highly cash generative, and it's good to have the option with a debt facility like that. So, whether they really need to use it or not, I'm not sure. But, I think that I very much trust that they will be disciplined in their acquisition approach. I mean, 20 years of track record delivering 20% returns, I think, that gives me confidence that they will be continue, to allocate capital smartly going forwards.
Yeah, yeah, no, that makes a lot of sense. I mean, you mentioned that they've generated a 22%, I think, cash on cash return over 20 years. However, I note that returns dropped to about 7% annually over the 2019 to 24 period. Now, I appreciate that, that's been a turbulent time. We had COVID, we had the war in Ukraine, we had inflation. Is this symptomatic of that, or is there something deeper going on? And you mentioned earlier that Halma's returns fell from over 20% to in the 10 to 15 range after reaching 500 million in revenue. And although the Judges is a long way off of that at the moment, I think it's got 150 in revenue, I think you mentioned. Has the geotech deal kind of accelerated Judges' journey down that curve?
I don't think so. I mean, that period ending 2024 was unusually turbulent. So we did have that 1 year where geotech subsidiary Coring did not have an expedition. We also had actually the Chinese market almost being shut out to Western companies for a while, with the government encouraging companies to buy local. So we had some headwinds there. And just to give you some context, I think free cash flow for Judges fell from almost 25 million pounds in 2023 to, I think, 16 million in 24. So a big drop there, which I don't think reflects major underlying changes. So if you look at this year, for example, geotech has reverted back to normal. We saw in the first half the resumption of those expeditions. Yeah. The Chinese market has improved as well.
Okay.
Unfortunately, at the same time, we've had this decline in the US academic spending because of the Trump administration's pressure on funding. I would say that is also a one-off. I don't anticipate these budgets being cut dramatically forever. In fact, Congress has actually just passed a budget that is for pretty much flat spending. So there could be quite a strong rebound. So that's all a way of saying I don't think that the lower returns in the recent period reflect a structural change. I think they reflect some of these headwinds that are temporary.
Okay, interesting. So staying with the theme of capital allocation, I've always found that the best way to assess any corporate management team is to analyze its approach to capital allocation. And in my book, there should be a kind of a waterfall approach. The first choice should always be reinvestment at good incremental returns on capital. And the next should be consideration of deleveraging the balance sheet and repurchase of shares at a discount to intrinsic value if the opportunity presents itself. And then once all of those options are exhausted to your bottom of the waterfall, if the company has surplus capital, for which it genuinely has no need, then it should return that to shareholders. And that's kind of a partial liquidation of the balance sheet. If you've got a surplus cash, why not give it back? But that in effect is what we call a dividend. And most of the top performing CEOs tend to do it this way. If you think about Buffett, Jeff Bezos, Henry Singleton, John Malone, they all adopted a similar waterfall approach. But Judges doesn't seem to do it this way. And Ciccarel seems to be kind of operating from an old playbook. Now, I know he's kind of stood down as CEO. Maybe the new guard will bring in some changes. But Judges has always had this progressive dividend policy, which is very British, it's very old fashioned, and it targets a 10% annual increase in dividend payments annually. Which always seem to be the priority. So instead of dividends being the last resort, the bottom of the waterfall, with Judges, they're at the top of the waterfall, which to my mind is kind of upside down, back to front thinking. When management can generate 22% returns on capital, distribution of capital carries a huge opportunity cost. And to make matters worse, Judges has an average 103% reinvestment rate, despite having a high payout ratio, which kind of implies to me that they don't have surplus capital and they're effectively borrowing to pay dividends. which is kind of madness. And I know that shareholders have lobbied on this point, and it typically comes up in earnings calls, in questions, the rounds of Q&A afterwards. And in the second half of 2024 earnings call in particular, when he was pressed on this issue, Ciccarel's response opened up a much bigger conversation about incentives, capital allocation, and who the company was really being run for. At least that was kind of the undercurrent. That's what I was reading between the lines. So first, he said they want shareholders to make money not only by selling their shares but by holding on to them. So that's the way he's thinking about this. So that's why he wants to pay dividends. He doesn't want to force the shareholders into liquidating part of their holding. Now, on the surface, that sounds perfectly reasonable, but mathematically, it just doesn't seem to hold. Doesn't seem to sit right. What matters isn't how many shares you own, but the value of your holding. So if the business is compounding at 20 or 22% a year, an investor can sell down 2 or 3% of their holding, and the value of their investment will still be rising without the company ever having to pay a dividend. A dividend is an attempt. It's kind of a one-size-fits-all attempt to suit everybody, which is impossible because not all shareholders want a dividend, and those that do require different amounts of income, and they don't all need them at exactly the same point in time. Managing tax liabilities, etc., is not always convenient for everybody to get the dividend at the same time. And so, the logic for me doesn't really stack up very well. And so, kind of reading between the lines, it feels more like a personal preference for David Ciccarel. He's the biggest shareholder in the company, and the bulk of his wealth is tied up in this particular business. And so, dividends allow him to generate cash without selling down his own stake. And it kind of reveals, I think, a conflict of interest there, where the CEO, at least the prior CEO, the founder, was putting himself before doing what's necessarily in the best interest of the company and its other shareholders. He didn't want to dilute down his own position by having to sell to raise income. And then he argued that relying on selling shares instead of receiving dividends puts investors at the mercy of market sentiment. And he was arguing, what happens if the business is performing well but the market's depressed? And he referenced the great financial crisis as kind of an example of when that might happen. But again, it kind of feels a bit of a weak excuse because up until recently, Judges Scientific has spent most of its life trading at very high premiums to intrinsic value, which would present investors with a great opportunity to sell down some of their portfolio. They'd never having been forced to sell at kind of bargain basement prices. And then his third point was that the value of a share is connected. I didn't get this at all. He said the value of the share is connected to the discounted value of future dividends. And I think that's a misunderstanding on his part of financial theory. Textbook theory would tell you that a company is worth the present value of its future cash flows, but not that the share price is the discounted value of future dividends. Indeed, if his version were true, then companies like Amazon and Berkshire Hathaway would have shares that were worthless because neither company pays a dividend at all. So it doesn't seem to add up at all. And he even referenced, because he was challenged on the Berkshire Hathaway point, the fact that Berkshire Hathaway don't pay dividends, and he said that although Warren Buffett and Charlie Munger, until he passed away, didn't like to pay dividends, they did like to receive dividends. But the comparison doesn't land very well because, although Berkshire Hathaway uses the cash generated by its investees to buy both public and private companies, that fuels its compounding machine, which is exactly the same model that Judges Scientific follows. So this seems to be a bit of a misunderstanding on his part. I don't know. It seemed to me to be kind of a disingenuous attempt to reflect the question. I don't know. How do you feel about this?
Well, I largely agree with you, I would say. I won't defend the dividend policy because I don't think they should be paying a dividend. I think that when you have a 20-year track record of delivering 22% returns, then you should allocate your capital to that instead of paying a dividend minus income tax. So I completely agree with that. I also think that just mathematically, if someone did want to generate income, you could sell down a portion of your shares each year, which would be the equivalent of a dividend, but with a lower tax leakage. So I think that would still be a better choice than a dividend, unless the shares were really, it does matter, I guess, whether you sell shares or buy shares. Obviously, what the share price is, that does, of course, matter. But just in general, you're going to save tax if you generate income through selling shares than through a dividend. So I agree with all of that. Probably a couple things I would say is I don't think it's necessarily disingenuous in the sense that he believes something different to what he's saying. I think he probably does believe what he's saying. I think he's incorrect in that belief. unfortunately, a lot of UK CEOs, as you know, have this opinion. There's a very strong dividend culture in the UK, which I don't always agree with, but it is what it is. So I've never raised this point with them because I sort of feel like they've made their minds on that. But probably the last thing I would say is, although I disagree with that dividend policy, and as well, when they make an acquisition, they can finance some of that through debt. So they don't need necessarily to finance 100% of the acquisition through their own cash. Um, but ultimately they have delivered, 20%, 22% returns for 20 years,
Yeah.
and a similar share price return. So it's sort of hard for me to be too critical of them when their overall record of capital allocation is so outstanding, albeit I disagree with them on this particular point.
Yeah, no, fair enough. Okay. So we touched earlier on the fact that the share price had collapsed 50, 60% from its May 2024 peak. I'm just wondering, in your mind, how much of that is geotech and how much is a loss of investor confidence? And then kind of finally, how much of it is the macro, the Chinese issues you raised earlier and the US university funding?
Yeah, I think that hard to say how much is each one, but the decline began with poor results with geotech and China, so that's certainly a large amount of it, and has continued with the big cuts in US academic funding, which by the way have bottomed, and there's a little bit of commentary of it now rebounding. I don't think that will rebound for judges just yet, but there will be probably quite a strong rebound. Once we see increasing resolutions between universities in the US and the Trump administration. So we've seen some of those already, and I think that it's been widely reported that there are more coming. So that's temporary as well. But there's no doubt those series of events have impacted the share price and have impacted confidence. You would think a company with a 20-year record of 22% returns, and even with the share price drawdown, I think almost 25% shareholder returns. You would think that it would have generated such confidence and goodwill amongst investors that some of these, what I think are temporary factors, would not have had such a big impact, but they have, and I think that that's partly because this company is still very small and it just isn't well covered. I mean, I certainly don't know anyone who's been invested in Judges for a long period of time and would have built up that confidence in themselves. So I think that's why there's been such a strong reaction, and that's why I think it's such a great opportunity, and why I'm invested in the company, because I think this is a really great business with a great management team and track record that's on sale because of some temporary headwinds.
Okay. You mentioned earlier about the China onshoring situation, and that seemed to be resolving. So is it the case that the Chinese government are no longer insisting on sourcing domestically?
I think the biggest reason actually is that some of the equipment that Judges supplies cannot be replicated or has not been replicated by a local supplier, and so many of those customers have had to come back to Judges because they've tried alternatives and it didn't work. So that's kind of quite a good test of their competitive advantage.
Okay. And we spoke earlier about the components of the share price increase over the years, and the fact that effectively the drawdown was all a multiple contraction. All of the other elements are still, still there. But the share price seems now to have come back to a level. So I'm just thinking about where the multiple was prior to the collapse. I think it was trading at 50 or 60 times earnings, right? And yes, it was growing rapidly, but that seemed like an eye-watering multiple, which some argued at the time was kind of unsustainable. And the geotech was just kind of a catalyst for a correction. So do you think that that's what it was? It was a correction and now we're closer to fair value? Or do you think the pendulum has now swung too far the other way?
I think it swung too far. Although you're right, on a PE basis or EV/EBIT basis, it was trading on multiples like 50 times. I think it's important to recognize that um, in their P&L, they have to amortize acquired intangibles. And so because they make so many acquisitions, there's a very significant non-cash amortization that goes through the P&L that depresses their reported earnings. So I think in the 2023 to 24 period, for example, most recent two full years, they had on average about £10.5 million of amortization for acquired intangibles, which is a non-cash charge, and EBIT was about just under 20 million. So it depressed their reported earnings by about one third. So that's why I prefer to look at it on a free cash flow basis. Now, on that basis, it was still trading at quite an elevated multiple, about 30 times, 35 times. And I'm certainly not assuming 30 times in my valuation. But if you look at it today, it's trading on probably 20 times what its free cash flow this year will be. But that's a period of time where US academic funding has really plummeted. So their free cash flow a couple years ago was 25 million. And the business, they've made additional acquisitions since then, and the underlying businesses have grown. So their underlying earnings power should be well above 25 from a couple of years ago. So I would argue that their underlying earnings power means that their current multiple is really something like 15 times or less. And I think that's a very cheap multiple to buy a business of this quality. The way I think about it is, if this company can keep reinvesting close to 100% of its earnings at a 20% rate of return, or even a little bit less, well, what that means is it will grow earnings at about 20% a year for a period of time. And even if you assume it's only 15% earnings growth for quite a number of years, a business like that should trade on a much higher multiple than 15 times, in my opinion. In my evaluation, I assume just above 25 times, but you can take whatever multiple you think is appropriate. And the way I would think about the return algorithm from here is, if they can grow earnings at 15% plus on an underlying basis for 3 years, you've got, once you compound that, just over 50% appreciation just from that. And then you've got multiple expansion, which in my case, I think can be very significant. But, if you want to take a more cautious approach, maybe it's less, but you can still get a very strong return over a 3-year basis, sort of through a series of multiples that you think is appropriate.
Okay, just thinking about the Chinese situation and the fact that the Chinese have a reputation for kind of imitating wherever they can. And judges have been running the playbook now for about 20 odd years, and a lot of the companies they acquired had intellectual property rights over the products they produce. But patents only last so long, right? And so I'm wondering, I don't know if you know the answer to this, but when do the patents start to roll off? And is there a danger that when they do, China and others will simply just produce these machines at lower cost?
Yeah, so I don't know when the patents roll off, but obviously there are 25 businesses, so it will be quite a range. I think the threat from China is quite a bit less in this industry than it is in other manufacturing industries, and the reason is because I think China's very good at manufacturing high volume. This is very low volume, high value equipment. So, these are businesses with 5 to 10 million pounds in revenue. So this would not typically be the type of industry I think that China would go after. And we haven't really seen that so far.
Okay. And then just thinking about other UK programmatic acquirers and US acquirers, I suppose, in the same scientific space. So we've got, Thermo Fisher, you've got Halma, we've mentioned earlier, Oxford Instruments, Diploma. How do they stack up side by side in terms of risk reward and valuations?
Yeah, I think Halma is obviously at a well over one order of magnitude bigger in scale. So it just doesn't have the opportunity. If you look at Halma 20 years ago was generating 20% returns on capital, incremental capital. Today it's closer to 10. So it just doesn't have the same opportunity. I don't recall the multiple off the top of my head, but I have looked at it and it's not particularly cheap, certainly compared to Judges. So I think that's just, the law of large numbers, as you mentioned earlier. I think Oxford Instruments and Thermo Fisher are much more about integrating acquired businesses. So I would say more a serial acquirer under what you've talked about rather than a programmatic acquirer. The multiples those businesses are trading at are not super cheap either. And then Diploma, I've looked at less, but again, much greater scale, not a particularly cheap multiple. And so I think Judges is unique. I mean, the one I would compare it to is SDI, which is an even smaller business listed in the UK. Very similar approach until recently. What's changed with them is
I'm familiar with that SDI actually, and so
yes,
I used to have a good line of communication with Mike Creedon, who was the kind of he came in as CFO, I think 2010, and then he took the reins as CEO, and he turned what was then a failing business effectively into a programmatic acquirer of scientific equipment, and he ran the business really, really well and scaled it up, and he was a good reader, and he used to study the likes of Buffett. He'd read books like The Outsiders by Will Thorndike, and he was a certain type. Before he made an acquisition, he used to go and sit in the cafeteria of the company that he was looking to acquire, and he used to try and speak to as many employees as he could. For about a week or so, he'd sit there, drinking coffees and speaking to people. And this was the kind of man he was, and that's why SDI worked. Now he retired about a year and a half ago. And they promoted an operations guy to CEO, and he just doesn't have the same makeup, I don't think, as Creedon. And since then, the shares have kind of collapsed, and I'm not sure if they'll ever come back because, as I always say, the same company with a different CEO is no longer the same company. And I think that's
Particularly for an acquirer, a programmatic acquirer. I mean, he's making those decisions.
exactly right. So no, that's interesting. Okay. So do you think the scale of judges is what's perhaps holding back the recovery? What I mean by that is that, if it doesn't, it's a micro cap company. The market cap's about 300 million. It's too small for institutional investors. It's not really on any of the indices that will be included in passive funds. Do you think that's what's holding it back relative to some of the others in this area?
Well, I think it would certainly be valued higher if it was bigger, and also if it was not listed on the AIM exchange. So yes, that is a negative, but also, I mean, I don't think about that too much because that's not going to change. It will change organically as the share price, resumes its previous trajectory. But yeah, it's not going to change too long. I mean, interestingly, I wrote up Terravest, I think a couple of years ago, maybe 2.5 years ago now, when it was a similar market cap to Judges, and listed in Canada. And when it got to about $1 billion in market cap, it really inflected upwards in terms of its multiple because at that point all these institutional shareholders could invest in the company, and so you had this whole new group of people who looked at it differently. They didn't look at Terravest as just a storage tank, manufacturer. They looked at it, well, this is actually a serial acquirer and it's got a fantastic record, etc. And they valued it appropriately at that point. The Judges is still some ways from that. I mean, it would need to more than double its market cap, almost triple really. So that will happen in the future, but not yet.
Okay. And then, just kind of bringing this round to a close, we've been speaking for a long time here. So, a lot of investors are feeling the hurt after a 50 to 60% drawdown. And I'm wondering, were there any red flags and clues that investors missed? For instance, we spoke about the fact that at its peak, it was capitalized at around 70 times earning. It was kind of priced to perfection because it had such a strong track record of returns. People just assumed that was going on forever. Nothing could ever go wrong. And then we discussed earlier about the incentives. What were the management incentives poorly designed? Charlie Munger always used to say, "Show me the incentives, and I'll tell you the outcome." For instance, Prestige, when he joined the company, he was granted 120,000 options between, I think, March 23 and January 25. And I'm wondering, did the new executives feel pressure to prove themselves with a big swing on the geotech deal, for instance? So, that the incentives perhaps caused that. And then, the other thing is, aside from Ciccarel having a 9.2% stake, there aren't really any other large shareholders. And the shareholder base is pretty diverse, which means that there's a lack of a strong voice to adequately challenge the management amongst the shareholders. Are these red flags that people ought to have spotted in advance?
Yeah, I think on Prestige, and Wilcox, I don't think they will have pushed for acquisitions or wanted to prove themselves through acquisitions. So I don't think that would have been a main driver. I think that I can certainly tell you what I got wrong in terms of red flags. I've been invested since about the middle of last year. So my drawdown has been significantly less than if someone had invested at the peak. But I certainly underappreciated the how rapidly the U.S. academic environment had changed and how rapidly that spending had reduced. In the research I did speak to people and ask them specifically that question. And although there were some discussions about a reduction in spending in the US academic community, I mean, it was nothing like what we actually saw, which was an almost complete halt in spending on judges' instruments in that segment. So, that's what I missed. And now that is temporary because the reason that happened was because all these universities suddenly found out they may not be getting funding for these projects. And so, of course, they just eliminated their spending on these expensive pieces of equipment. And so that was why it was so sudden, and that will reverse. In terms of red flags from beforehand, I think that it was the multiple was certainly well above what I'm putting it on in terms of my valuation. So I think that probably was too high a multiple. Obviously, I did not invest at that price, for that reason. So that was a red flag. And I think the good thing is that today it's trading at a much lower multiple, and you don't have to assume anything like the multiple it used to trade on to be able to get a double over 3 years.
Mm-hmm. Okay. So just to wrap up, kind of rapid fire question for you. I think I know your answer to this anyway. judges Scientific today? Is it a buy because it's oversold? Is it a hold because we need to wait for proof of a turnaround and just see how the new management fare? Or is it a sell because trust's been broken and there's been irreparable damage?
I think it's a buy. I think it's still a great management, great business, great track record that's going through some headwinds, and that these will be temporary.
Excellent, very good. Well, thank you, Chris. It's been really good chatting with you about this. Hopefully, we can do another one on another one of the companies you've studied recently, and hopefully this was useful for all of the listeners as well. So thank you again. And before we wrap up, anything we missed, Chris, that you just want to throw in?
No, I think that's it. Yeah, thank you very much for having me. And I know that you've done a lot of work on this, not just this company, but a number of programmatic acquirers on Rock and Turner, which I've enjoyed. I've written judges up on hidden gems investing and TerraVest. So those two specifically, rather than the whole sector. And I might write more about some other programmatic acquirers in future.
Excellent. Okay. Well, something to look forward to. Thank you again, Chris, and have a great day.
We really hope that you enjoyed today's podcast, but we really only scratched the surface. If you want to explore any of the themes discussed in more detail, see the show notes or visit us at rockandturner.substack.com. Oh, one more thing. Be sure to like the episode, share it with others, and save it to your favorites so that you don't miss future episodes. Until next time, we wish you every success with your investments.